Hello and welcome to your daily note for April the 7th, 2022. So we're back from a relaxation retreat over the last couple days here, and I wanted to get back with you as we got some economic data as well as the Fed minutes from their last FOMC meeting. We're primarily going to talk mostly about the FOMC meeting and dig into how the market has been reacting. Of course, as we start April, we've gotten a little bit of a pullback from the recent rally that we have seen. There was no surprise and no change in kind of our commentary or our conversations. I was using the bounce to stay defensive, raise additional cash, and we've continued to do that here. Now, what's interesting about this most recent sell-off is the jawboning from Federal Reserve officials. So it seems like as we start this week and as many deliver their speeches, they're all moving and talking in tandem about how much more they're going to have to do or how much greater financial conditions are going to have to tighten before they feel like they've broken the back of inflation. If we come down here, I'm starting a new slide here on the Fed balance sheet. And on side of the Fed balance sheet here, you're not really starting to see this rollover just yet. And of course, they haven't started this reduction process yet. They just stopped purchasing. But it's fair to say that within the next couple meetings here that you're going to see this start to top out and start to roll off here. The most recent period that we can look at is the 2017 to 2019 period. That period there is what we need to primarily be looking at because that was the last tightening cycle. If we look at that 2017 to 2019 period, even with the reduction of the balance sheet, you can see that financial conditions didn't tighten very much during that period. This period, I think, is going to be dramatically different. I think they will move a little bit faster, and I think tightening of financial conditions are the secondary tool to raising interest rates. I think their interest rate tool, given how far the market has moved the yield curve, the interest rate tool is kind of a moot point now. They can move a little bit faster as long as they stay in line with market expectations. But the other part that they can do is this balance sheet runoff, and that can really tighten these financial conditions. A line in the sand is that zero line. If you start to get financial conditions or financial stress above that line, I think you do get into a situation of causing another recession. Now, let's talk a little bit about what the Fed has mentioned in their last meeting here. So I'm going to skip down to actual plans for reducing the balance sheet, and I've highlighted a couple sections here. So all of the options that were featured in this plan featured a more rapid pace of balance sheet runoff than in 2017 and 2019. So to go back here again, here's that period, 2017 to 2019. So you did get a pretty good reduction of the balance sheet here. What they're saying is they want that to be much faster. And again, here is the financial conditions of 2017 to 2019. They did get tighter, as you can see, it's a little bit of an increase, but I expect things to get much tighter than there. The options differed primarily with respect to the size of the monthly caps for securities redemption in the SOMA portfolio. In their discussion, all participants agreed that elevated inflation and tight labor market conditions warranted commencement of balance sheet runoff at a coming meeting with a faster pace of decline in security holdings than over the 2017-2019 period. Participants reaffirmed the Federal Reserve security holdings should be reduced over time in a predictable manner, primarily by adjusting the amounts reinvested of principal payments received from securities held in the SOMA. Participants generally agreed that the monthly cap of about $60 billion for Treasury securities and about $35 billion for agency mortgage-backed securities would likely be appropriate. Participants also generally agreed that the caps could be phased in over a period of 3 months or modestly longer if market conditions warranted this. Against this backdrop, participants generally agreed that it would be appropriate to first slow and then stop the decline in the size of the balance sheet, when reserve balances were above the level the committee judged to be consistent with ample reserves, thereby allowing reserves to decline more gradually as non-reserve liabilities increased over time. Participants agreed that lessons learned from the previous balance sheet reduction episode should inform the committee's current approach to reaching ample reserve levels, and that close monitoring of money market conditions and indicators of near ample reserves should help inform adjustments to the pace of runoff. Finally, no decision regarding the committee's plan to reduce the Federal Reserve balance sheet was made at this meeting, but participants agreed they had made substantial progress on the plan, and the committee was well placed to begin the process of reducing the size of the balance sheet as early as after the conclusion of its upcoming meeting in May. So one of the things that I wanted to point out is down here at the bottom. Mostly everybody voted for this action except for Bullard. Bullard was the only one that dissented. He believed that there needed to be a 0.5 basis point increase in the federal funds rate at this meeting. However, all the participants were on the same page that inflation was running well above their 2% target and that they needed to tighten financial conditions and monetary policy abruptly. And so that's why I think you're also getting the reaction that you're getting in financial markets. You know, if we look at that 2017-2019 period, the runoff was very, very slow, very gradual. I remember Janet Yellen, for part of it, was talking about how it was going to be automatic, running in the background, and it was going to be like watching paint dry. And for the most part, it was, because, again, you can see that financial conditions were still very, very easy throughout 2017 and didn't really start to tighten until the back half of 2018, starting in 2019. This time is a little different. So they're starting the balance sheet runoff after financial conditions have already tightened. So take the Fed at their word. I highlighted this in, I believe, the October meeting and in the January meeting, that Jerome Powell specifically said that they're moving away from an accommodative policy stance and the economy warrants a tightening policy stance. And I think they're going to be true to their word because, again, financial conditions have already gotten tight, and as the balance sheet runs off, they're going to get tighter. Estimates from studies that have been conducted is that a $300 billion runoff can equate to a 0.25% rate hike. So if they're running off $95 billion a month, you're looking at 3 months, so 1 quarter is going to give you an extra 0.25% increase, quote unquote, in interest rates. So if they want the terminal rate at 1.9% by the end of this year, and then they also do the runoff of another 0.25% per quarter starting in May, we can tack on probably another 75 basis points or so to get you to about 2.65 on the federal funds rate. Now, that's not too far from some estimates that I have been seeing and that I've been even running as well. One that I would like to show you here, if I could get it pulled up. I'm going to pull up this Excel sheet and show you one of the things that we've been working on here and trying to understand. This is a chart of the modified Taylor rule. Now, the Taylor rule is really interesting. The Taylor rule helps set more of a policy framework around where the Fed funds rate should be in relation to the output gap and inflation. In fact, the equation is the Fed funds rate should be equal to the neutral rate of interest plus the inflation rate plus 0.5% times the inflation gap, which is inflation minus the targeting rate that they want, which is 2% here in the U.S., plus 0.5% times the output gap, so potential GDP minus real GDP. Now, what you can see here is that the Taylor rule says that the federal funds rate should be north of 5% right now. but we had to modify it. We had to modify it because there's question as far as what that neutral rate is. See, Taylor always believed that the neutral rate in the economy was 2%. In comments that are coming out by these FOM officials, they're saying that 2.5% is also possible. We ran our estimates. I'm going to show you what our estimates of the neutral rate is here. Let me highlight a couple of these just to show you what those could look like. And I'm also going to put the Fed funds rate in there as well. We're going to make all of these lines so that way we can see them a little bit better. Okay. So let's delete this chart here, and I'm going to show you our estimate of the neutral rate, which is what I think can explain what the Fed needs to do. So here's our estimate of the neutral rate. So the blue line is the federal funds rate. The orange line is the Taylor's neutral rate, which again is modified based on his equation. The gray line is our estimate of the neutral rate in the economy, and the yellow line is the one-year Treasury rate minus inflationary rate. I'm looking at a situation where the neutral rate is negative, given the slow economic growth and output and the high inflation impact, which is pushing real yields negative. And the Federal Reserve, in my opinion, wants to get this neutral rate positive. Now, if they do that, using our estimate here in gray, that's at minus 2.98. That would mean the federal funds rate needs to be at 3%. So this combination of, the balance sheet runoff and raising interest rates, I think, is going to get you there. The question is, do they have enough runway, and will financial conditions tighten too much to where the economy slows down dramatically? And I think that's where the conversation is going to run into whether or not we have a recession at the end or in the middle of 2022, or if we have a recession starting in 2023. The reason why I say that is it's all going to be based around how quick the Fed moves and how much accommodation they remove, as well as how quickly inflation comes down. So with that, stay cautious. Again, I have not changed our model estimates. We're going to finish our monthly update and our quarterly update, as well as record a conversation with Dr. Ron Sanderson as far as our updates there. And if you have any questions at all, don't hesitate to reach out to us. It's a very, very tough market scenario when you have both the equity market and the fixed income market selling together. It's why we use an optimization program to help us evaluate. If you lean on the averages, the average weight of the equity side is roughly 51%. The fixed income side is only about 20%, given how far these rates have risen. And then the alternative side has another 20%, and the cash side has about 7 to 8% right now. So it's not perfect. We are getting hit on the fixed income side, but I do think it's providing a little bit more coverage in this uncertain marketplace. So with that, we'll be back again tomorrow as we got initial jobless claims today and wholesale inventories tomorrow. Reach out to us if you have any questions. We thank you. Have a great Thursday.